Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and Fintech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome back. I'm your host, Jeff Bogan. Today's guest is Sheel Mohnot, co-founder and general partner of Better Tomorrow Ventures, a venture capital fund which invests in fintech companies globally. He's also a general partner of the 500 Fintech Fund, multiple startup experiences, even was a consultant at BCG, which I won't hold against you. And then one thing that I thought was really interesting was started your career at Kiva.
Yeah.
When I was in school, my class, we basically invested something like $1,000 in Kiva, and we've had it running now for 20 years, and we keep making investments. So like a really cool organization. So I want to definitely learn more about that. But I want to welcome you to the podcast, Sheel, and thanks a lot for joining us.
Thank you for having me. That's a cool story about Kiva.
Yeah. So give me how did you start at Kiva? How did you get connected there? Are you still involved?
Yeah. So
tell everyone what Kiva is.
Sure. So Kiva is a website where individuals, primarily in the developed world, can make loans directly to people in the developing world for the sake of alleviating poverty. So, for example, an example we gave in the early days was somebody in Kenya, a farmer, needs an irrigation pump. That's going to be catalytic to his life because by getting that pump, his crops are going to be way more productive. And that pump only costs $500, but he's going to make an extra $200 each year. So the payback period kind of makes sense. And there are a lot of people in the developed world who want to help people like that. And so companies started, or the nonprofit started in 2004 or maybe 5. And I heard about it and was super excited about it. And actually at the same time I was moving to India. And when I was moving to India, I wanted to work in the nonprofit sector, wanted to really get an experience for what it's like to live like that borrower. So I actually lived in India on $1 a day working for Kiva, and I was serving those folks, and it was crazy. It was actually like, I think you'll appreciate it, to serve a single borrower at that time meant you would get on a public bus and then ride on the back of somebody's motorcycle. And that's every week to service that loan. And so you can imagine how expensive the costs are. Just people say, why are the interest rates so high? And they don't realize how are you expected to get your money back if that's what it takes? So, obviously things have improved quite a bit and technology has made things so much better. And actually, so Matt and Premal were the two founders of Kiva, very close friends of mine. And Matt went on to start Branch, which is doing something similar in the emerging markets, but through the smartphone.
That's interesting. And then remember Kiva, it was kind of you wouldn't necessarily have to do the entire project, right? Couldn't 10 different groups chip in and fund. And so you could diversify your funds across multiple.
That's exactly right.
Recipients and so forth. Yeah.
What's crazy is the term crowdfunding didn't exist back then. That came about afterwards. And actually, relevant to consumer lending in general, there were Prosper and Zopa had kind of launched around that time. And so we were looking at those models. But the idea was you could lend as little as $25.
Yep.
And a lot of people started out that way.
Yep. That's a good way to diversify.
Exactly.
So maybe go from you're riding on the back of a motorcycle to collect funds to why did you decide to make a career in fintech and why are you interested in it? And clearly you've been extremely successful at it. What has been the key to that so far for you?
Yeah, some of it, of course, is just I was exposed to it. So through Kiva, through when I was at BCG, which you're not holding against me. I primarily worked in financial services, so I was serving banks and insurance stuff. And so it was partially what I knew, and then partially just felt like there's a tremendous opportunity. Like this, you have the ability to change people's lives and make them better. And at the same time, it's just a massive pool of profits. You know, 20% of the global GDP is in financial services. And I just feel like it's still not as digital as I want it to be. There are still things that I have to deal with on a regular basis that I'm annoyed at. And I wish that more stuff was digital. I wish I could do more from my phone. I wish, I wish I didn't ever have to go to a bank branch, but occasionally I do.
Yep.
Uh, and so all those things feel like opportunities.
Right. I also like, I mean, for me, fintech, I like the complexity of the interplay with credit, technology, customer experience, the regulatory environment. I mean, it's an extremely complex ecosystem
Yeah,
that we operate in. And to be successful, you have to be good at every single aspect of it.
for sure. And actually, like, I don't know if you mentioned, but the interest rate environment.
Right. Right.
So there's so many factors at play. It's whatever 5D chess or something like that.
Yeah. No, it's great though. And so Better Tomorrow Ventures, you were co-founder of the fund. Talk to me about the strategy, why you started it, some of your more successful investments, and basically kind of what you've learned as a venture investor that you didn't know when you were an operator.
Yeah. So we started the fund about 5.5 years ago, end of 2019, and the idea was really, fintech is a huge category, as we already talked about, and it felt like it didn't have a sector specific fund leading pre-seed and seed rounds. And that's what we do. And maybe there were a few folks in and around the area, but it felt like for such a big part of the economy, there should be folks who are specialized in it. And I previously founded a couple of fintech companies. My partner Jake also was a founder of a fintech company called NerdWallet, and we felt like because we have that expertise and interest, we should start a fund that is dedicated to this category. And it's played out really well. There are other folks that there already were other folks in the industry that we looked up to. Certainly Ribbit and QED existed before us, but they weren't investing at the earliest stages. And we felt like seed investing is actually where it makes the most sense to have folks who've done it before in the same sector, because there's so many things that you're doing to get up to speed, and there's so many partnerships you need with the bank and all this kind of stuff that we can be really helpful for, more so than the next stage of your startup. So that's why we decided to focus at seed, and it's also frankly what we love doing and what we've done in our own businesses multiple times. And I sort of love helping avoid people make the same mistakes I've made in my past.
Yeah,
I think you'd
exactly.
ask, what are some companies we've invested in? So we had a pre-BTV portfolio, which is myself and Jake are investing prior to BTV. Those companies, they're certainly some you'd recognize. There's Ramp, credit card for startups, Mercury, bank for startups, Flexport, which is a full service freight forwarder, Human Interest, Ironclad. Those are some in the pre BTV era, and then in the BTV era, there's Unit, which is a great banking as a service company. There's Coast, a fleet payments company. There's Mendel, an expense company for Mexico, and many others.
Yeah. What I love about the strategy of your fund is, I always kind of joke, everyone loves to talk about iPhones. As a percent of GDP, iPhone sales is not that big.
Mm-hmm.
But fintech and financial services is a massive sector. And even if you talk about the portfolio companies that you have, you went from fleet management, international, lending, deposit taking. I mean, and that you're just touching a small portion of that 20%. When you're looking to make investments, do you find sectors within the financial services that you want to go after, and then you find entrepreneurs that you think can help solve those problems? Or is it more typical that entrepreneurs will come to you with a problem and then you'll leverage your experience to decide if that's a bet that you want to make.
It's almost always that entrepreneurs come to us with an idea.
Yeah.
And we invest. There are some exceptions where it's something where we guided an entrepreneur towards an idea. But for the most part, we are investing in people. At the stage that we invest, so much could change in the business. Like it could be, in some cases, it could be an entirely different business. Like we have companies that started out as a consumer focused business, ended up in a B2B enterprise sales motion, and ended up being successful. But what doesn't change is the founders. Sometimes the founders change too, but usually not the CEO. And so more than anything else, we're investing in a general area that a founder wants to go after, and then their ability to execute on their plan and attract talent around them.
Right. Right. And so what do you look for in those entrepreneurs? Like when you have a meeting with one, I mean, do you know within 5 minutes if you think that person has a shot, or do you put them through 10 hours of interviews or reference checks? I mean, or is that your secret sauce?
No, there's no secrets here. I think everybody has a similar style, and mine is, I would say I don't know in 5 minutes. I mean, there are some founders where I felt great about them in 5 minutes, but never where I thought I'm going to invest right now. You always have to do a lot more work and meet folks multiple times, ideally. But in terms of what I look for, I would say speed. Like startups are about moving fast. It's iterating. It's talking to customers, learning, and then making a change in the model a little bit here. It's all these tweaks that you're doing. And the more you're able to move fast, the more you're able to iterate and build what customers actually want. So speed is up there. Tenacity is another. As you know, in the world of fintech, so many things can go wrong in every dimension. Partnership with a bank, or a regulatory issue, or a customer issue. So many things go wrong, and it's easy to give up and say, I've tried as much as I could, and now this obstacle came in my way, so I'm giving up. And so some people give up and some people don't. Some people just fight through it. And so I'd say tenacity is a really big one that we love to see. Actually, a fun story on that. I just learned that one of my portfolio companies, a company's called Charlie.com, they build financial products for seniors. And I've always thought about Kevin, the CEO, as being a really tenacious guy. Like a few things have come up, like for a debt deal he was structuring that last minute got turned off, and then he made it happen. Anyway, the story is a couple of weeks ago, I saw Bill Clinton tweeted this story of an 11-year-old boy who was an immigrant from Iran and was so persistent that he called the White House for an elementary school project. He had to interview somebody, and he was like, okay, I'm going to interview Bill Clinton. So he called the White House so many times that eventually they patched it through to Bill Clinton, and eventually Bill Clinton flew out to meet him and interview.
Oh my gosh!
He interviewed Bill Clinton for his
and that's the founder
elementary
of Charlie?
School, and that's the founder of Charlie. And I didn't even know this story, but it just shows you like tenacity has served him really well in life.
Yeah, well, I can tell you, I think my first bank partnership took almost 2 years to get off the ground. So tenacity is important, and he's definitely going to have the right mentality to go after that.
Exactly. And then the final thing I'll say is actually articulation. So being able to articulate what it is that you're building is really important, because you of course have to convince me, an investor, but also very importantly, future employees, customers, and downstream capital as well, of multiple kinds, debt and equity in some cases.
No, that makes sense. That makes sense a lot. On the bank side, I mean, what do you see as the role and interaction between fintech and the banking industry in general? I mean, to me, it needs to be symbiotic.
Oh, absolutely.
But, what's your take on it? What advice do you give your founders who are basically looking to enter into aspects of banking or partner with banks? I mean, how do you see that relationship?
Yeah, it's funny. I think from the outside, everyone thought all fintech is trying to get rid of banks, but actually, like, generally you need to partner with banks, become one. And, but in terms of advice, I'd say, to your point, banking partnerships are going to take a
Tenacity.
lot longer than you think. And all of, that's, you asked about like what we look for. And one thing is realistic timelines. Some people, think they're going to get a banking partnership off the ground in a matter of months. And I'm just like, good luck, guys. You do not know what you're in for. And even though I can help you along the way, it's still going to be a lot longer than you think. And that can be difficult in the world of venture where, we're giving you a certain amount of money that only lasts for 18 or 24 months. And if you haven't made progress in that time, it's going to be hard for your business. So that can be very difficult. So it's often about being realistic and not, and making sure that you have the runway to get there. So don't hire a team too far in advance of when you think you're going to go live, because it's probably going to be a waste of money as the bank takes longer time. So I'd say that those are some things. But ultimately, you know, finding the right partner is important, and the right partner for one company is probably not the right partner for another company. That's something that we can be really helpful at, just because we've seen so many of these things, and for the most part, us.
And how many of your investments are investments in companies that sell a product to a fintech or to a bank? For
Yeah,
example, the last 2 years, every AI company in customer service compliance across the board has been pitching us an upgrade.
yeah,
But we're really excited about the opportunities there. So, like, how many of your businesses are kind of like more like a Charlie, which is probably direct to consumer type
yeah, they are.
product,
Yeah,
versus infrastructure just selling into fintechs and banks?
yeah. We have a lot more on the infrastructure side than
Yeah.
we do on the consumer side. I think, and part of that is a lot of the great consumer opportunities. Um, we're kind of serving an underbanked audience that was picked off a while ago. So, in the 10 to 15 years ago zone, you had the Robinhood's, Wealthfronts, Chimes of the world get started. And then after that, there might be niches that were available, but like the larger ones were not necessarily available. And then, of course, customer acquisition became a lot more difficult over time. And then also, as it became easier to build these companies because of the infrastructure companies like a Unit and others, there just became a lot more competition. So like it was hard for Chime to get off the ground. For these new companies, they were able to get off the ground in a month or two, but that meant that there's just so much more competition. So we've done more on the infrastructure side. We've done some on SMB side as well, but a lot more infrastructure that serves either fintechs, banks, or sort of non-fintech companies that want to become fintech companies. So as an example, think about Toast or MindBody or Gloss Genius. These are vertical SaaS companies serving restaurants, yoga studios, and salons. And all of them are partnered with our portfolio companies for various things. Unit is a banking as a service company. So if Toast wanted to provide banking or debit card services to their restaurants, they'd partner with Unit. Or we have a company that does the same thing for payroll. Gloss Genius is partnered with our portfolio company Salsa that builds payroll for them. And you could build payroll on your own, but that would be a very big undertaking. And so partnering with our company makes sense. And the same is true for another one of our portfolio companies, Layer, which is embedded accounting. So same thing. You're a restaurant. You have, of all the things you have to do, you also have to do this bookkeeping, and would make your life a lot easier if Toast, which already has a lot of information about you,
Right.
was doing your bookkeeping. You wouldn't have to export and
Right.
import into QuickBooks and that sort of stuff. So that's another example.
And do they, in that situation, do they brand it Toast or is it branded
Yeah,
level? How does that
it's
work?
branded by the by the vertical SaaS. So it's
Yeah.
a white label product. And that is true of Unit, Salsa, and Layer, all three of them.
Yeah. No, that's interesting. What we can't have a podcast without talking about AI. And I actually sat through, we had a board meeting and we were kind of reviewing how AI could impact our business across multiple dimensions. Are there particular areas that you're excited about in serving kind of the fintech and banking community with AI? I'm sure you're getting pitched a ton by founders with ideas.
Yeah.
There's almost too many of them now. And so like, how
Yeah.
do you search through that mess?
I can only imagine how many sort of AI collections agent companies you guys have looked at, or voice agents, because I've seen so many, and I'm sure they all want to pitch you guys. Um, in our world, I'd say where we've invested are, I think there's like some of these companies will be eliminated because your generic chat GPT or the like will do some of this work, the foundational models. Uh, but we want to invest in companies where there's some angle for which a general model may not make sense in something specialized. So whether that's compliance or a workflow particular reason. So those are the kinds of things we like to invest in, and we've invested in what we call services as software. So where you're actually buying a result. Um, and an example is we have an investment in the accounting space. We mentioned Layer, which serves vertical SaaS companies. They have an AI component that does the bookkeeping. We have another company called Basis that sells AI into large accounting firms, and they automate the work of a junior accountant. We have a company called Kaj that does underwriting for business loans, onboarding and underwriting for business loans, and sort of automates that process and prepares a credit report without human intervention. We have another company that does, it's called Monk, and it does accounts receivable. So automating that process. And we think that each of these are big opportunities that, you have humans involved that shouldn't be, because AI can do a better job. It's not only cost savings, or in the case of accounting, there's an accountant shortage. So you just cannot hire enough accountants, but it's actually just AI can just do a better job, especially in some of these areas where you have sort of like fuzzy, unstructured data, but then rules that they can follow once they structure the data.
Right. And that's why they need to be specialized. A generic model can't go in and solve those problems. You need to be specialized.
Exactly.
I mean, what I like about it for us is on the compliance side, for example, we used to sample X percent of calls.
Yeah.
Right? Now there's software where every single call can be analyzed.
Yeah.
So it reduces risk for the company. It creates better customer experiences. Notice nothing I'm saying is about headcount or expenses or all of that. It's literally reducing risk and providing a better experience for team members, which to me is the most exciting aspect of this.
Yeah, exactly. And I think there have been so many false starts along the way. I saw that Klarna is hiring people again.
Yeah, that was interesting, wasn't it?
Yeah, super interesting. And I think they probably overplayed their hand with some of this stuff, maybe a little bit before it was ready for prime time. But there certainly are use cases where, like, I don't want to wait on hold, and I would rather talk to an AI.
Right.
So I think there are plenty of opportunities.
Yeah.
But I think you still want that human touch.
Yeah. We have a lot of bank and credit union executives that listen to the podcast.
Yeah.
They're all getting pitched in the same way that I am. What advice do you have for them when evaluating, an AI company with a shiny presentation? How would you recommend they conduct their diligence, and advice you would give even for like the integration once it's picked? I mean, what's the best way for banks and credit unions to work with your portfolio companies, for example?
Okay, so how to pick, I think the way to think about it is you have to think like a venture capitalist. Like, the same things I'm looking for are basically what you should be looking for too. And that's, because you want the company to be around, and they're not going to be successful unless they've sold multiple of your customers, and also been able to attract venture capital dollars. So the first thing we look at is the team, as I mentioned. I think beyond that, we look at the tech, and is the product something that we think is unique and people really want to use? And then, from a bank perspective, I think what we hope for our portfolio is not to get stuck in a crazy procurement process. And what happens is, like, our portfolio companies talk to each other. So, like, they know, like, okay, it's not worth wasting your time with this bank. So like when you go through and say, okay, like we're going to do a 9-month POC or something, it's like, okay, like these startups are working on a tighter timeline than you are, which is, and it's totally understandable that you have a timeline. But I think a better way to do it is to launch it to a subset of customers first, and but do a full launch. And I think, yeah, I think customers appreciate that, or the startups appreciate it.
Yeah, yeah, that makes sense. What about new areas of investment within kind of financial services and that 20% GDP segment? Like, what are two or three sectors that you're particularly intrigued with today?
Yeah. So, I still am intrigued by accounting, which we've already talked about. Um, I'd say like I still think there are opportunities in mortgage. We talked about consumer a little bit. I would say I'm again a little bit intrigued by consumer, primarily
Oh,
because
interesting.
it may be contrarian, and to be fair, I have been saying this for the past year, but I have only done one consumer investment during this time. So maybe it's just like I want to be excited by consumer, but I'm not. Uh, but yeah, I would say across the board we're excited, and we tend to be more um, founder driven than we are thesis driven.
Yeah, that's what you said at the beginning, where you don't necessarily pick a sector. It's you find a founder, believe in that founder, support them. Yeah, I think
Exactly.
that makes sense. That makes sense. What about so the consumer has been on a heck of a ride since COVID in March of 2020,
Yeah.
right? I mean, interest rate shock, COVID, we've had a looming recession 3 months away for the last 7 years. I mean, what's your take on even like, consumer confidence, right? I mean, it was terrible 2 months ago, and then yesterday it comes out at a 98. It's a little hard to figure out the state of the consumer these days. What's your take on the consumer and their stability and, where things go from here?
The consumer is fickle and more so than ever, I think. And it's hard to know. I think we've had really significant volatility this year, with you know, news from potential tariffs and then undoing tariffs. I mean, that was pretty big. But then also, I think, we've interest rates were zero. There was no student loan repayment. There's so many things that are impacting consumers, that it's really hard to know how people are going to react. And tariffs go from really high one day to really low and come off of smartphones. Honestly, it's hard to stay on top of all this for me, an investor and somebody who studies this stuff. So I think it's really hard for a consumer to really know. I think if we probably didn't see the immediate results that people thought they would see from the tariffs, primarily because the tariffs came off. Um, but and then I think that gave consumers confidence that, okay, maybe it's not going to be so bad. But really, the tariffs hadn't really kicked in yet, and we keep seeming to kick the can down the road. So
I know.
I don't know. It's hard to say.
It's really hard. I mean, I think you almost have to just, I mean, our approach is keep your head down, build good products, and the markets are going to do what they're going to do. But I'm hoping eventually they settle down a little bit.
Yeah, I mean, you see things like, for the first time, you see companies not giving guidance or giving two different
Yeah.
guidances depending on what they think happens.
Yeah.
It's a crazy world out there. So if companies are having a hard time forecasting, I think the average consumer is just really unsure.
Yeah. So you've had a really interesting career. What's next in your journey? You're going to stay as a VC investor? You have any side jobs you want to pick up? Like what's next for you? You're a very busy man.
Yeah, no, I think so. Throughout my life, I've always did have multiple things going on. Like when I was a consultant, I also ran a side business, but I did a bunch of other stuff. But I think it was all because I hadn't found what I truly love. And I think the beauty of being a VC, and not only a VC, but building a firm, has been so rewarding for me. I get to work on other people's stuff. Sure. Like the portfolio is just so fun to work with companies and founders I really love working with. But then also we're building something ourselves as a firm. And, our team is awesome. Love spending time with them. The whole thing's just been great. So I'm going to be doing this for a very long time. I hope I will, as long as I get the chance to, I will be doing
Yeah,
this.
a lot of mentorship, I assume, because you have all those portfolio CEOs, then you have the junior investors on your team and just your network in general. So I bet that's very rewarding.
It's super rewarding. It's so fun.
Well, good. Well, thank you so much for coming on the Consumer Lending Perspectives podcast brought to you by Upgrade. We welcome your emails to investor@upgrade.com on guests and topics. Be sure to subscribe for notifications about future episodes. Until next time, I'm your host, Jeff Bogan. And Sheel, thank you so much for taking the time with us today.
Thank you, Jeff. This is fun.
All right. Thanks.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders. And share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.